Management of Dixon Technologies to talk a little bit about their overall margin outlook, the synergies from Xiaomi and Samsung, as well as what kind of a slowdown we're seeing in electronics with respect to the China slowdown. We've got Atul Lall, Managing Director, Dixon Technologies, now joining in. Good to have you on board, Mr. Lall. To begin with, given that in the last few quarters we had seen quite a bit of strong growth in your revenues, it's now tempered off quite significantly, just about 25%. What would be the reason for that, especially with the fact that we've had the festive season, the holiday sales as well play out in Q3?
You see, Q3 sales is, there's always a slowdown because this post-Diwali sale. And as compared to last year, Diwali this year was slightly earlier. So the Q2, the actual sale flip came in Q2, where the revenue growth was much higher. So this is normal. This is normal. And in Q4, we are finding the sales getting back to normal, and you will find a significant growth. So the Q3 was, again, it was a very normal kind of phenomena which happens in our industry, where the peaking takes place around the festive period. So that's it.
In India, the challenge has been that we are importing white goods. We are importing our phones, we are importing a lot of white goods. Given that corporate tax has come down, Samsung has been successful in setting up their manufacturing. That is one area where some would argue that demand is there. It's only we Indian manufacturing companies were not very efficient, or they were not very profitable. So post the corporate tax rate cut, how has life changed for the Indian manufacturing durable industry?
You see, we are of a firm belief that the Indian consumer electronics and durable industry, whatever is being sold in India would be manufactured in India. So if you look at, let's say washing machines or appliances, 90% of the washing machines or refrigerators sold in India are manufactured in India. 70-75% of the televisions sold in India are manufactured in India. More than 80-85% of the indoor lighting products sold in India are manufactured in India. And this is going to keep on further enhancing. Two reasons. One, arbitrage being created by the tariff structure set up by the government, policies of the government lately to support manufacturing in India, and third, the China cost significantly increasing. So we feel that this is going to be the way forward. Definitely the corporate tax cut is extremely good for our industry because investments are around the corner. In our case, we're expanding capacities across all our verticals. So in televisions, we are increasing capacity from 3.4 million to 4.8 million. In washing machines, from 1 million to 1.6 million. In mobile, we have set up a new plant with a capacity of 2 million a month. So it's right across. And definitely the corporate tax reduction is a significant move for enhancing the investments in our sector.
You've recently added, Xiaomi and Samsung as well in the last year. Tell us about what kind of an opportunity really could this open up in terms of a volume game going forward, because much unlike the globe, everyone here in India is either on a Samsung or on a Xiaomi.
So in our LED television vertical, we did 1.1 million televisions last year in the whole fiscal. We feel that this year we're going to close at around 2.2 million. So that's almost 100% growth. With acquisition of new account in Samsung and also our anchor customer Xiaomi doing extremely well, we have a very healthy order book for 2021. And we are confident of achieving a growth of 35 to 40% in televisions as a vertical. And our Samsung relationship goes across. So we do for them washing machines and we do for them mobiles. which is a unit which has gone into commercial production in November only. And we are already at 100% capacity utilization in January.
You specify that what has been the corporate tax benefit in your PAT, because that's where I would imagine that the delta would have kicked in for you.
So we used to be at almost 34% and presently it's around 25.2%.
Can you also, I'm simply trying to understand that your stock has gone from 2,500 to 4,000, which means markets are extremely excited about what Dixon is doing and where things are moving. One large challenge for India has been cheap Chinese import dumping, especially in the television space, also in the non-branded space and the smartphone space. Now that Chinese production cost is moving higher, and there is going to be a huge change in the way how tariff laws would be governed. How will your organized manufacturing business change? And given that the economy is becoming more informal to formal, how will these benefits kick in for a firm like Dixon, which is in the business of contract manufacturing?
So we firmly believe, as we were just sharing, that one, the China cost going up, markets migrating from informal to the formal sector, more and more companies looking at India manufacturing. In Dixon and in India electronics manufacturing, we are acquiring the requisite scale which kicks in the operating leverage. These are all significant tailwinds which really help us in Dixon in growth. However, in Dixon's case, also extremely important focus is on capital allocations, which enhances our return on capital employed and return on equity. So please appreciate that in this fiscal, in the first 9 months, we have grown in revenues by more than 60%. But at the end of December 31st, we are negative debt stage. We have a return on capital employed of 33%. We have a return on equity of 24%. We generate enough cash to support our expansion programs. So these are extreme positives for a very strong balance sheet.
And from you, given the fact that now, when we're speaking to other corporates, the likes of Vijay Sales as well, there's some sort of an indication that these LED TVs now, the viewership is really subsiding, or people are not really using this as a medium, with the Netflix, your mobile phone as your 11th finger practically. I just want to understand how this has impacted you, and even with respect to your import content from China in terms of your build materials, with respect to the coronavirus, how much has that impacted your overall inventory or your supply chain?
So the first question on the television. So this is a fact that overall LED television industry, the growth is in single digits. However, in Dixon's case, the growth has been extremely aggressive because our focus is always on new customer acquisition because we are an outsourcing contract manufacturing company. And second is to get a larger pie of business from our anchor customers. So that's the reason we've been growing, and we are confident with the new customer acquisitions. The growth will be extremely good in the coming quarters. On the coronavirus, yes, we are dependent on China for large imports of our components. In this particular incident, because there was Chinese New Year around the corner, we had imported for our February and March coverage. So those are either in our factories or on the high seas. So we are fine with that. However, the factories which were supposed to open on 3rd or 4th of February post Chinese New Year, we understand now they're expected to open by around 9th or 10th. If that happens, then we are still okay. But if there's a further delay, then there would be an impact.
Okay, fine, fair enough. That's because we understand that the latest status is now it's going to be delayed by about a week or so. Thank you so much for taking time out and joining in, giving us a perspective, on your overall performance as well as how things are shaping up in light of the kind of slowdown that we're seeing. That's Atul Lall, MD at Dixon Technologies.